Good evening. This is Kyle Lott. Be presenting to you today McKesson Drug Company, a SWOT analysis, income statements, statement of cash flows, balance sheet, and some ratio analysis. McKesson Corporation is an American company distributing pharmaceuticals at a retail sale level and providing healthcare information, medical supplies, and care management tools. The company had revenues of $198.5 billion in 2017. This slide represents just a few of the core pieces to McKesson. The parent company is McKesson Pharmaceuticals, although today we're going to be talking about their wholesale drug distribution system. On the stock exchange, this is listed as a pharmaceutical company. In the healthcare, their tagline or slogan is Empowering Healthcare. Again, this is a pharmaceutical distribution company in healthcare technology. Their target group is obviously pharmacies, medical and pharmaceutical manufacturers, hospitals, and insurers. Their positioning is that McKesson is dedicated to delivering the vital medicine, medical supplies, and information technologies that enable the healthcare industry to provide patients better, safer care. My SWOT analysis is pretty broad, but I want to point out a few highlights. McKesson employs 36,000 people in their distribution division, but for the entire company, they have 68,000. This company's been around since the early 1800s, originally called Alcott and McKesson. They're based out of San Francisco, California. Some strengths that we've uncovered in this SWOT analysis is they have a very diversified portfolio in the pharmaceutical wholesale business. Again, they got a lot of employees, 36,000. They're in 2,700 retail pharmacies around the country, a lot of physicians' offices and use them. Some weaknesses that we've uncovered is their reliance on a very limited business segment. And of course, there's always legal complications with patents and drug testing in the wholesale market. Opportunities that McKesson has is they got a very robust market for generic medicines. They actually stock their own GPO and offer pharmacies discounts if you stick to their buying group. Expanded healthcare needs of the aging population, public policy agenda supporting access to healthcare solutions, and a higher margin of business in fast-growing sectors such as oncology are all opportunities. A couple of threats is changes in the legal aspect of the healthcare business, and there are several other major software players entering the healthcare sector. This slide, titled The Income Statement, represents current numbers and prior years all the way to 5 years ago, and a couple of the points. Revenue dollars are represented in millions. Revenue continues to increase while the cost of goods sold also increased proportionally. The income from the continuous operations also details a promising trend and increase in every year represented. The net income rose by $2,843, which is a 55% increase. I do see two troublesome trends on the balance sheet. The AR, accounts receivable, is increasing over time while cash on hand is decreasing. These two indicators reflect poor collection efforts resulting in decreased funds to pay bills timely. Creditors will charge the company more interest if the net terms on their invoices are not paid. However, the ratio analysis shows this is a minor change. McKesson is a wholesaler again of pharmaceuticals and medical supplies, and they must have a strong accounts receivable policy to stay in business, as most of their goods are sold on credit. The balance sheet also reflects that stockholder equity is rising. which means the company has issued more stocks. Issuance of stocks is one method to raise capital. Cash is down over the previous year, while long-term investments are up. This can be interpreted that McKesson has put their cash to work. Inventory is down over the previous year, meaning more money is in liquid assets, and indicative of strong sales as evident by the income statement. Liabilities are up, but so are sales. Current liabilities stayed about the same. Total assets went up. The value of stocks improved over the year. One method of maintaining just enough cash on hand to cover liabilities is to use a controlled disbursement of checks from the bank. This allows checks to be paid and covered while keeping as much cash in interest-bearing accounts as possible. Cash flows is the header of this slide, along with the shared information. Cash flow from operations is over the represented 3-year period, and again indicative of strong sales and collections. Dividends paid are up. Investors in the company made money over the represented period. Interest paid went down as debt was paid off. Earnings per share increased substantially, while market share at the year end and shares outstanding decreased some. This could happen when treasury stocks are issued and the company is buying back its own stock. I displayed several pertinent economic performance ratios on this slide, and I'll discuss comparisons of McKesson to that of Cardinal Health, which is its closest competitor. Let's look at some of the growth ratios. Sales growth declined by 2.6% over the year, while income growth of the company made a substantial increase of 98.2%. As compared to Cardinal, a 6.94% current year was compared to 18.5% last year's growth ratio. Cardinal continues to grow, but had a decline of 11.61% over that same period of time. The investment portfolio of the company performed very well. This is also evident of the growth in the asset ratio of 3%. This is not to imply that sales were poor, but rather did not grow as much as the previous year. It's worth noting that the previous year did not show any long-term investments, and the current year is booked with $4,063, again represented in millions. I would at this point validate this data with the CFO or auditors to make sure it's not an oversight on data collection. This is inaccurate. The company is investing, if this is an accurate reflection, the company is investing in long-term growth. The activity ratios listed did not reflect any significant changes or variance. The receivables turnover ratio indicates that efficiency in which the company controls the credit it issues to customers and collects on that credit. Because accounts receivable or monies owed on a credit agreement without interest, by maintaining the accounts receivable, companies are offering interest-free loans to the clients. As compared to Cardinal Health's receivables, a turnover of 17.45 last year to 16.82, McKesson continues to run its collections better. Inventory turnover measures how fast the company is selling inventory and is generally compared against the industry averages. A low turnover implies a weak sales and therefore excess in inventory. A high ratio implies either strong sales and or large discounts. McKesson has maintained its average relatively close to Cardinal's average of 11.6 last year and 11.26 of this year. Some profitability ratios. McKesson shows an increase in their overall profit margins, return on assets, and return on equity. This has indicated that they have increased their productivity financially of its use of its assets. They've controlled their expenses, and I'll say that's usually difficult in the drug business, thereby creating a more productive asset. As an investor-owned business, the return on equity is just as promising, showing a steady rise on this ratio. This indicates the productive use of assets. Cardinal reports a profit margin of 1.17 last year and 0.99 this year. Cardinal's return on assets was 4.44 last year and 3.47 this year. All of these reported comparative ratios suggest that McKesson is performing at or better than its closest competitor, Cardinal Health. The price-earnings ratio, along with dividend payout ratio, decrease was expected as indicated by selling stocks. The price the investors expect to earn per share will go down. This last slide shows that liquidity ratios indicate that McKesson is able to pay its debts as they come due. The current ratio is mainly used to give an idea of the company's ability to pay back its liabilities with its assets. The higher the current ratio, the more capable the company is of paying off its debt, as it has a larger portion of assets relative to the value of its liabilities. A ratio under 1 indicates the company's liabilities are greater than its assets and suggests that the company in question would be unable to pay off its obligations if they came to at that point. You'll see some solvency ratios here. The debt to total assets indicating an improving company in terms of its total debt and in terms of its assets. The tie ratio has also increased, meaning the companies can pay its bills. I'll end this presentation with an overview of the references used. Thank you for your time.